Hello, this is Larry Tentarelli. I'm the president and founder of Blue Chip Daily Trend Report with a special report and video today titled Bear Market Rally or Final Market Bottom, 5 signs to look for, 5 ways to invest and trade it. And what I wanted to do here is share what I'm seeing in the markets right now. Probably the biggest question that I get from friends, relatives, people that I engage with online is, where do I think we are right now? Do I think this is a bear market rally? Do I think we've seen the final market low? So I wanted to share my experience. I started trading in 1998. So I've been through 3 major bear markets since then. 2000, 2007, and then 2020, we had the COVID bear market. And then there's been a few sharp drawdowns along the way. So I'm going to go through some charts, share what I've seen in the past, share what I see right now, and hope that you find this informative. So we'll start with the disclaimer. If you would just read this for a minute, it basically says that everything in this video is for informational purposes only. It's not financial advice, and it shouldn't be treated as so. So we'll get started. We'll take a look at where we are right now. So 2022, I'm sure, as everyone knows, has been the most volatile year in the S&P 500. Since 2008, the traditional 60-40 portfolio, 60-40, 60% stocks, 40% bonds, has had its worst year-to-date return in the past 100 years. And I think that everyone is aware of that as we've been in the markets this year. So where we are right now is the S&P 500 had a very high volume reversal day, October 13th, after the CPI was reported. And if you take a look on the chart below, we can see October 13, big gap down, very, very sharp reversal, high volume day, highest volume up day since the end of June. And it looks like the 4th or the 3rd highest volume day since those June lows. So my view right now, and I'll go into a lot more detail, but my view right now is I'm treating October 13th as at least a tradable low right now. It could always develop into more. The key number for me is 3,500. So I want to see S&P close over 3,500 going forward. So I'm not saying that the final lows aren't in. They very well could be. I haven't seen all of the signs that I look for yet. There's quite a few factors that could increase the chances. But let's go into the charts and we'll take a look at where we are right now. So I've been trading actively and investing since 1998. 3 technical bear markets since then: the 2000 bear market, 2007, and 2020. Also a very sharp drawdown in 2018 that we'll take a look at. So I'm going to share my experience from the past, what I see right now, but I'm not going to make any comparison to prior bear markets as far as how far they went down, what the duration was, because each market stands on its own. Now, I will say at the 2018 lows, I did go all in with a buy, 60% on SPY. And at the time, I did see all 5 of the market bottom signals that I look for. Also in 2020, I also saw all 5 of the signals that I look for, and we'll go through these right now. So 5 factors that I've observed in prior final bear market lows. So we'll get started with number 1, a very high volume selling flush and reversal. Number 2, a sharp spike and reversal in volatility in the VIX. 3, extremely oversold oscillator readings. 4, extreme pessimism and low investor exposure. And then number 5 is Fed easing. So we'll take a look at these 5. We'll start with number 1. So price and volume is always first for me. So a very high volume selling flush and reversal. So if we take a look at the 2002 bear market low, we can see at the first low attempt in July, very, very high volume selling flush and reversal higher. Markets tested higher for a few weeks, retest in October, Once again, very, very high volume, selling flush and reversal. So this level here, 52.67, 52.49, that turned out to be the final lows. And we can see at the lows, the volume was off the charts, 2 highest volume weeks in that entire time frame. It looks like about 3 years. So volume off the charts, more shallow retest, and then higher. And the volume was also higher here, but at the low and at the retest, the volume was the highest on the screen. 2009 bear market low. Volume was a little bit different. There was a lot of selling right after Lehman in 2008, and then the low came in 2009 in March. But we can see very high volume, and at the low, this was the highest volume for the year. Now, it is on a weekly basis. Now, it is noteworthy that in 2008, 196 S&P 500 stocks put in their low in Q4 2008 in all of this high volume shakeout. So it's important to realize that there are stocks and sectors that can bottom before the index, but we're just going to talk about the index right now. If you click onto that link in the blog, you can read a report that I put together a few years ago about that. 2018 bear market lows. So this was not a bear market, but it was a very high volume sell-off and reversal. We can see once again for that near-term low, volume was off the chart. 2018, very sharp drawdown. We can see at the low and reversal, the volume stands out. So the 2 highest volume weeks that are on the screen, a low here, and then a low and a reversal here. So once again, volume leads the way. 2020, bear market low. We can see very, very high volume shakeout here, more follow through, and then the reversal higher. So once again, this very, very high volume sell-off marked what turned out to be the final low in that bear market. 2022. So I don't think that we've seen yet the very high volume shakeout that we saw in prior bear market lows. Now, we did see it in January, and this ideally would have held, if this would have held as a technical signal, this would be the high volume reversal, but it didn't. It made lower lows. We had some volume come in May. We had nice volume in June. And then where we are right now with this recent recovery attempt, we just haven't seen that massive volume bar that jumps off the screen that we saw in prior bear market lows. We did see it here, but that didn't hold. So as far as checkpoint number 1, if we've seen the massive volume reversal and move higher, we can't check that off. At least I can't as of yet. So number 2, a sharp spike and reversal in volatility and the VIX. We'll take a look at this group. My experience in major bear market lows is we normally get a volatility spike, 1 or 2. So 2000 to 02, there was a spike to 43 in 01 right after September 11th. Then in 02, spike to 45, and then the markets eventually put in their low. 07 to 09, a spike to 89, and then the markets put in the low. VIX was at 53. 2018, we reached 50 at the January low, and then 36. So nothing over 40 here at that December 2018 low. And this December 2018 low came right after a Fed pivot, and we'll talk about that in a few minutes. 2020, VIX reached 85, so a very sharp spike. Then in 2022, we haven't seen the major spike as of yet. So 38, 37, it's been in the 30s. Now, keep in mind, the 2018 low did come with VIX under 40. So it's possible, and I've read a lot of detailed explanations as far as why the VIX has been lower this year. I don't get that far into it, but as far as my checkbox of a major volatility spike, I can't check that off as of yet. So if we take a look at the S&P, this is an overlay. Red and black is VIX. The solid black line is the S&P. So if we take a look at the low here, VIX spike, at the final low here, also a VIX spike, looks like 45 and 42. 09 at the final low, VIX was about 53. 2018, S&P low here, VIX at 50. S&P low here, VIX at 36. So that was the outlier, under 40. 2020, S&P 500 low, VIX was at 85. So we haven't seen that sharp VIX spike over 40, 45, 50, whatever it is. And I'm not saying that we have to, but when I see that, it's one more item that I can check off of a final bear market low. Now we're going to get into two readings that we definitely can check off on the final bottom checklist. So extremely oversold oscillator readings. S&P 500 McClellan oscillator reached the fourth most oversold level on record, negative 152.31 in late September 2022. So if we take a look at this, this was a few weeks ago. This measures advancing and declining statistics on the S&P 500. Anything under negative 100 is considered oversold, positive 100 overbought, but negative 152.31 is the fourth lowest. So 1, 2, only 3 instances below that over the past 25 years. So negative 152.31 end of September often leads to a very sharp reversal. Negative 165 in March 2020, negative 173 in December, and then it looks like negative 155 or so in 2010. Other than that, the 02 market lows, 08, 07, 08, 09, did not reach that level. So as far as extremely oversold oscillators, we can definitely check that box off. So we'll go to item number 4, and this is extreme pessimism and low investors and fund manager positioning. So we'll take a look at the information on this. This is going to be another box that we can check off. AAII Bulls and Bears. This is a measure of individual investor sentiment. The solid black line is bears, bearishness. Red and black is bullishness. So we can see it reached this year 72, which is the highest level over the past 25 years. And right now where it's at in the mid 50s, it looks like 56 and change. At the very, very high end of the range, 56 and change, 1 time, 2 times, 3 times, has only been reached 3 times in the past 25 years. So individual investors are very pessimistic right now. More importantly, we'll go to the Bank of America Global Fund Manager Survey. This is dated October 18, 22. It is a report that's available to the general public, especially to Merrill Lynch Bank of America clients. So we'll start with their headlines. Global Fund Manager Survey, and their fund managers that are surveyed manage over $1 trillion. Fund Manager Survey screams macro capitulation, investor capitulation, start of policy capitulation. Cash levels 6.3%, the highest since April 2001. Fund Manager Survey macro capitulation done. So global growth expectations from their fund managers are at net negative 72%, near all-time lows, extremely pessimistic. So they've thrown in the towel on growth expectations. Fund Manager Survey investor capitulation done. Relative to the 20-year history, 2.6 standard deviations overweight cash, 3 standard deviations underweight equities in the doesn't get much worse territory. So global fund managers have basically thrown in the towel on stocks and are very pessimistic right now. If we look at cash levels, October 22 is the highest going back to April 2001, highest level in 21 years. If we look at their positioning, overweight cash, underweight equities, this can be considered as a bullish contrarian signal. And the reason is this: fund managers right now are extremely pessimistic, very high degree of cash, 21-year highs, very low equity positioning. If for some reason the markets get any type of an upside reversal, it could be if the final lows are in it, if bond yields come down, if there's a Fed pivot, if earnings come in, if we get a seasonal rally, if there's a short covering rally, for whatever reason, if stocks continue to move higher, what happens with these fund managers is they're going to get into the year-end performance chasing game where they're overweight cash, they're underweight stocks. A lot of them have had a difficult year. And now they're going to, if stocks start to move higher, now they have to start to buy stocks to try to get their performance to keep up with the market. So this can be treated as a contrarian positive signal here, and that's definitely a box. So we can check off so far 2 of the 4 boxes on the checklist. So box number 5, we can't check off as of yet. So this is Fed easing and liquidity. So at the past 4 major market lows, the Fed was either cutting interest rates, engaged in QE, quantitative easing, or pivoted on their tightening stance. So the Fed's currently raising interest rates, their fastest pace in over 40 years. So we can't check off this box as of yet, but we'll just take a look at the details. In the year 2000, the Fed funds rate peaked at 6.5, and then they started to cut in 2001, and they eventually took rates from 6.5 in 2000 down to 1.25, which eventually we saw a bear market low. 2007 to 09, 4.75, September 18th of 07. They eventually started to cut, took rates down to effectively 0 in 2008, and they also started QE. 2018, they had raised rates quite a bit since 2016, 2017, 2018, but then they announced that they were going to stop raising rates. So that was a Fed pivot, and the markets put in a major low about 5 or 6 days later after that. 2020 rate cutting cycle, they started to cut rates in 2019, 2.25, eventually took them down to effectively 0, and then started QE. 2022 right now, we're in a Fed rate hiking cycle. So the target right now, end of year, is projected 4.25, 4.50 in the Fed funds futures market, up from effectively 0 beginning of the year. So we can't check that box off. One thing to take a look at, a key factor, is bond yields, because bond yields go hand in hand with liquidity. The chart on the screen is an overlay of 10-year US Treasury yields, which is the red and the black hash mark. The black solid line is the S&P 500 overlaid. So we can see since the beginning of the year, bond yields started to move higher. S&P 500 moved lower. In June, bond yields put in a short-term top. It looks like 340 and change or so. And we can see bond yields put in a top, S&P 500 put in a low, bond yields drifted lower, S&P 500 drifted higher. They intersected in August. Bond yields did a reversal, big breakout. S&P has been pretty much straight down since then. So it's the formula has been higher inflation equals higher bond yields equals lower stocks. So we definitely want to keep an eye on bond yields to get some direction on the stock market. So here's my summary of where we are, and then we'll talk about the best ideas that I've got for right now. So my view and positioning for now is that we've seen 2 of the 5 major bottoming signals: extremely oversold oscillators and extreme pessimism. I don't believe that we've seen the massive volume spike, that we've seen the volatility spike, and the Fed is still hiking right now. So my view, and this is key, my view right now is that October 13th is at least a tradable low. I want to see it hold over 3,500 in the S&P 500. And there's quite a few factors that could increase the chances of the final lows being in. So the purpose of this video is not to say, well, we've only reached 2 of the 5 major bottoming signals, So the lows definitely are not in. That's not the purpose of this video, because the lows could be in. But when I go through what I've seen at past major market lows, right now I can only check off 2 of those 5. Now, I have been increasing my equity exposure over the past week. I plan to increase some more exposure this week. I've been more tactical, and we'll go through what I'm seeing and 5 factors that could potentially mark the final low in this current market. So 5 best ideas to invest in trade. We'll go through these quickly. Number 1, I believe everyone should focus on their time frame, their own time frame, and reduce the amount of time spent watching CNBC or social media and trying to sort through it. And CNBC is a great information provider, but if we go on any financial media website right now, there's going to be 10 blogs. 5 will say the bottom is in, 5 will say the bottom's not in, and it's very easy for people to get confused. Social media, you might get 100 different opinions, and most people are really just throwing a dart at a board as far as trying to predict the markets. So I think it's more important for individuals focus on our own time frame, focus on a few key things that we find important, and I'll talk about ways to manage it, but don't focus so much on what XYZ fund manager says on CNBC or what someone on social media says, even if they've got 100,000 followers. It's more important that we focus on what works best for us and our time frame. Number 2, hold much higher cash. So the best true hedge is always cash. And my market mentor, who taught me this well over 25 years ago, always taught me that the best hedge is cash, and that's true, because here's the thing. Cash does not move in value. Hedges can be volatile. Put options, call options, spreads, whatever it is, inverse ETFs, shorting stocks, all of that can have a lot of volatility. We found that bonds can be extremely volatile. They've been straight down this year. Cash doesn't fluctuate. I always want to expect pullbacks, but having that extra cash, so we moved to over 50% cash February of this year, at the end of February. And it's been as high as over 90% at times. Having that extra cash, the most important thing that it does is it buys peace of mind. Because when we get into a market environment where stocks are up or down 2% on the day, some sectors are up or down 5% on the week, bonds are down 15 or 20%, whatever that number is, it's nice to know that that cash doesn't move. It's dry powder. It buys a lot of peace of mind. Now, the right cash level varies for everyone. Some people are comfortable with 10 to 20% cash. Some people like to have 80 to 90% cash. I'm not a fan of 100% cash, because when the final low does come, whether it's already in or if it's down the road, it comes so quickly that by the time people think, okay, well, maybe the bear market's over, stocks can be up 20, 30%. So I would rather have smaller positioning, more cash. We'll talk about that right now. So smaller positioning, reduced trading, reduced investing activity. So what I want to do in a case like this, if my normal ETF position sizing is 10 to 20%, then I want to dial it back here to 5 or 10%. If my normal stock position sizing is 5%, I'm going to dial it back to 2 to 3%. So I was always taught that more volatility equals more cash and smaller position sizing. So I definitely want to have positions. I want to stay engaged in what's happening in the market, but I want to take smaller positions. It is okay to hold positions on both sides, especially defensive hedges, but I don't try to actively trade both sides of the market at the same time. So what I mean is, right now I have S&P 500 puts that go out a few weeks just to protect me in case, for whatever reason, there's some type of an unwind, we get a macro news event, some type of an unwind in the market. But I'm not actively trying to build long positions and actively trying to build short positions. So I have a hedge. But right now I'm working on actively building and accumulating on the long side. Now, at some point that could change and I might have to add more downside exposure, but I'm not waking up every day and saying, what can I go long in and what can I go short in? I want to focus on one side of the market at a time while holding that hedge. And then I want my positions to be smaller. Here's the key thing. And this is where I think a lot of investors and traders get frustrated. Always expect volatility, sharp sector rotations, sharp pullbacks at any time. So we'll see a day when the S&P is higher, big reversal day. Someone will come out on social media and say, I think that the bottom is in, and then people think, okay, the bear market's over. Maybe it is, maybe it isn't, but it doesn't mean straight up all the time. So I always want to expect at any time, especially with the VIX near 30, I always want to expect sharp ranges of pullback at any time. If we wake up and the futures are down 2%, it's not going to surprise me whatsoever. If they're up 2%, that's not going to surprise me. If tech is up 5% and energy is down 5% for the week or vice versa, nothing's going to surprise me. So when we get into a high volatility market like this, every single day, we just need to have the mindset that markets are going to be volatile, can pull back at any time, and not let that be a major source of stress. Number 4, scale in and scale out. Basically, what I want to do is use the volatility to my favor. So if I'm looking to build positions in an ETF, let's say the S&P 500, or if I'm looking to build positions in some single stocks, what I want to do, because I expect continued volatility, is make a scaled in buy. So if I have 5% dedicated for an ETF position, I might make my first buy 2.5%. And then I'm going to look for a pullback so I can scale in, add another percent here, another percent there. And over the course of a week, maybe I get my full 5% position in. So buying a position with a planned multiple buy scale in strategy is not the same as adding to a losing position. So what I mean by this is if we buy a stock and we take our full, let's say 5% position, and then it starts to go down and we start to buy more, then we're adding to a loser. But if the plan is to go in due to volatility, if I've got 5% allocated to an or let's say 3%, I've got 3% allocated to XYZ stock, I might buy 1 to 1.5% of the position today, and then specify that I'm expecting that there could be some wide ranges. And on a pullback day, I could look to round out my position. So it's important to understand that. I believe in building gradual exposure in the volatility and also booking some gains along the way, raising stops and managing profits in the same way. Number 5, use downside hedges. I've got some basic S&P 500 put options. It's nothing advanced. I don't try to make it complicated, but I just want to have that peace of mind that in this market environment, if for some reason things start to get dicey, I know that I've got some downside protection against any outliers. Now, keep in mind, this is only what works for me. So this is not what anyone else should do. This is basically, we could consider this my notes to myself. But the first thing that I always want to do is cover the downside. Extra cash, downside hedges, very basic, and that's what works well for me. So a couple key factors to look for, and this is something that I talked about in the beginning of the video. What to watch right now: 5 potential catalysts that could improve the chances of the final lows being in. So the key thing, and I wanted to emphasize this, is the point of this video is not to say that because we've only seen 2 of the 5 items on my checklist, that the final lows cannot be in. That's not what the point is of this video whatsoever. Each market is unique. Markets can put in a low at any time. But here's 5 things that I'm looking for that I think could be outliers that would help. So Key levels, S&P 500, we talked about 3,500 on a closing basis, a close over 3,800 to confirm a range breakout. So here's the 5 things that I'm taking a look at right now that I think could be a major upside catalyst if they happen. Number 1, bond yields. If for some reason there was a sharp drop below 4% on the 10-year Treasury yield, I think that would be a big benefit to the S&P 500. Number 2, the volatility index. If there's a sharp close below 2,800, below 28, I think that would coincide with a move higher in stocks. Number 3, CPI and inflation data. It's been very high. If for some reason we turn on the computer one day and we find that CPI has dropped sharply for whatever reason, and this is not a prediction that it will, but if it does, right now I think it's 8.20. If CPI came down sharply, if some new inflation data came in and that came down sharply, I think that would be a major benefit for stocks. Number 4, the Fed and FOMC commentary. So on Friday, they put out a softer stance, some softer commentary, and the market's got a pretty sharp move higher. So if for some reason the Fed takes a softer approach to their hiking cycle, if they come out with commentary that's a little bit less aggressive, they don't even have to pivot. So I have not been in the Fed pivot camp at all, and I'm still not in the Fed pivot camp. But if they just take a softer stance, and they're very deliberate with what they say, if they take a softer stance, if they hint at any type of even just a pause, I think that would be a major positive. And then finally, any major resolution, Russia, Ukraine. So any one of these 5 key factors could be outliers if they transpire. And then finally, we'll spend a few seconds on the website. Blue Chip Daily Trend Report is my website. BlueChipDaily.com is the address. We have a 30-day free trial for the website. We've made some very strong calls this year. We sold out of the growth stocks, high beta growth, Snowflake, Netflix, Facebook, quite a few Affirm at the end of 2021, before in some cases 50 to 70% declines. Energy was our top sector coming into 2022. We booked triple-digit gains in that sector. We moved to 50% cash at the end of February, as I spoke about. And then we've been on top of the recent lows in some of these moves in the market. So I appreciate everyone's time. I hope that you enjoyed the video, and I look forward to seeing you online. Thank you.